The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
It is Friday the 7th of November. We've had fireworks night this week.
Yep.
Jeremy, I suppose I should start with a cheesy pun or something to do with fireworks in the markets. But anyway, hope you've had a good week. Great to have you back again, and interested in whether you think there have been fireworks.
There's a lot going on, that's for sure.
There is.
But, over the week, bond yields have been steady while equities have weakened. Oil prices firmed up over the weekend after the OPEC Plus meeting said that it would pause production increases into next year. But then they fell back again during the course of the week over concerns of US economic growth. But the overall scene was set really by the sort of confirmation over last weekend again that the grand bargain, if you like, that is yet to fully emerge between China and the US, basically trading rare earths for semiconductor technology, is a thing. Mm-hmm. And that gave markets a bit of relief, I guess. So that sort of steadied the background a bit. And I suppose then attention comes back to what's going on in the US, but a lot of it can't be officially reported on because one of the things the US government has reached this week is, I'd say, a milestone of dysfunction as the shutdown has reached a record, well, I think it must be now 38 days, which is the longest in history. So people are beginning to say this is enough now. And one would hope with the elections out of the way, and we've got a new mayor of New York, I think it can be hoped that they can come to some agreement on the Fed shutdown. That
would be good because, as we talked about last week, the data is becoming steadily less reliable and more aged. And even once they end the shutdown and get back to work, it'll take them a while to sort of pull together the data that they should have done over the last month or so. So how's that impacting on things then?
Well, I'd say the other factors to consider in the States have been continuing disagreement amongst the voting members of the FOMC, giving various interpretations of Jay Powell's sort of rather hawkish tones of last week. So we've had the Uber-dove Governor Miran, Trump's recent appointee, this week saying that he favours up to 100 basis points reduction in rates and feels that the level we're at is far too constraining. And then Goolsbee saying, to the point on the lack of reliable inflation data during the shutdown, life is more difficult when it's foggy, as he termed it. Let's just be a little bit more careful and slow down, which for him means slow down in the rate cutting cycle. So we haven't got anyone saying that rates should be raised that I'm aware of, but I think it's a question of how quickly these rates will come down. And I think this is interesting for a number of contexts. One is the politics and the overall view that we might have of the long-term independence of the central bank, but also, of course, the impact on the dollar, which I think significantly strengthened this week and at one point looked like it might break out above it, what traders would regard as a sort of critical 200-day moving average level. It happens to be just over 100 on the DXY dollar index. But things died down and we've sort of ended the week almost where we started, but it's been quite volatile.
To be fair, given some of the volatility that we've seen and the risks that are out there, you'd accept a slightly stronger dollar. It's not collapsing because people are giving up on it. The budget impasse isn't having too much of a painful effect, but equally it's not rocketing and causing all sorts of worries in terms of other countries' performance or in terms of the equity market positioning. So it's maybe not a bad place to have reached, actually.
Sure. And while there's increasing talk around the sustainability of the amazing performance of the US tech space and the conditions around the AI data center capex cycle, overall, there's still some pretty positive noises and solid results coming out of the US equity market. And again, although the market overall fell this week, it wasn't precipitous and it certainly doesn't feel like we're on the edge of a major sell-off. So, I'd say the highlights were perhaps the most highly valued company in the US, and the one that's sort of probably got the most retail support recently has been Palantir, that despite reporting blowout results and upgrading guidance, closed the week 8% down. So, some of these pockets of exuberance are being identified, I guess.
So you could say perhaps some of this exuberance is deflating, but it's not bursting, which is not a bad way for things to be going on, really.
I guess to the point of the bubble-like tendencies that we're seeing, Palantir on whatever it's on, 100 times revenue or something, it's obviously a bit less than that now. But if you thought it was expensive at the start of the week, it's still looking expensive. And there was a lot of headlines around the big short trader, Michael Berry, taking some pot shots at the Mag 7, including being short of Palantir. And the CEO of Palantir on the results statement said that he was more motivated to succeed within Palantir in order to impoverish Mr. Berry. It's a kind of talk that reminded me a bit of Jeffrey Skilling talking to his investors and analysts in 2001. We all know what happened after that because he was the chief executive of Enron.
Our younger listeners,
Yes.
that was the Enron story with Jeffrey Skilling. So yes, well, let's hope it's not quite the same, but it is interesting seeing the ways that some of these CEOs are reacting to all the conversations around the bubble. I think I saw something that Jensen Huang from NVIDIA this week has said that he expects China to win the AI race. But in terms of bubbles of deflating but not bursting, to have these conversations and for some of the CEOs to be out there with different mindsets or different reactions, it's not bad. And it allows the market to try and test these things a bit more and a bit more intelligently, perhaps than they've done before. And if that results in steady and sort of gradual market changes or shifting valuations, then that's a much more palatable or sort of acceptable way for it to happen than some kind of major collapse. So see what the next weeks bring.
Yeah, Jensen Huang seems to have replaced Elon Musk for being able to sort of slide around the world and adopt the right pose for whatever political circumstance he is in. He seems to be equally comfortable in Beijing to Washington, DC, which one wonders how long he can continue to do that. And he might be right that China actually wins the AI race, but he might have to do more than just see off NVIDIA and Jensen Huang, because Elon Musk has obviously had a good week this week. Overnight, his incentive scheme has finally been passed by Tesla shareholders. And as the headlines will tell us today, that he is, as a result of this, on track to become the world's first dollar trillionaire. He's got a few hurdles to pass before he reaches that point. It's in 2035, I think it was 12 distinct performance milestones for him to reach. And the little fact of Tesla will need to have a market cap of 8.3 trillion at that stage. So a six-fold increase from where Tesla is trading today. So he's got to do a lot of things and grow the business on a lot of different levels to achieve that. But he's come out swinging first thing. And overnight, he was saying he believed the new Tesla A15 and A16 chips, he thinks will surpass NVIDIA's Blackwell at 15% of the power consumption and an overall cost of something of the order of 10% of the cost of the NVIDIA chips. So really putting a marker down for his own shareholders, but also for the competition in the race for AI.
Yeah, although, Elon's got a bit of track record for putting markers down that don't necessarily get reached. But
Indeed.
To be fair to the guy, he delivers on some of them. And maybe that's enough. His shareholders obviously think it is. And to be fair, he's achieved an awful lot.
It's interesting looking at the US share price performances, admittedly only over the last week, but over the period of this incentive scheme approval, all of them are down. NVIDIA's down 5-6%, except Tesla, which is up to a new all-time high. So he's got his following.
He has, and now he's got his roadmap, so we'll see what he can deliver. Okay, what about closer to home? What about the UK? What's been going on here?
Well, amidst a firmer dollar, the pound came under a bit of pressure ahead of what was a pretty finely balanced rate decision by the Bank of England, and they came in with what has been termed a hawkish hold. But there was also a lot of drama and speculation around what's coming in the budget in 3 weeks' time. And Chancellor Rachel Reeves held an extraordinary press conference, I guess, where she sort of had this hurriedly arranged speech early one morning this week in order to say really not very much. And my interpretation of it would be prepare for bad news. And when it comes, just understand it's not my fault. And in fact, it's probably your fault, particularly if you voted leave in the referendum nearly 10 years ago. But I think while it was a speech that said nothing, its intent was really aimed at the bond markets rather than us taxpayers. And I think in that measure, at least initially, it was successful. Gilt yields fell, but they've since recovered to where they were previously. But it just reminded everybody that we've got this to come. Maybe it's all discounted. One thing is for sure, every time you open the paper at the moment, there's a new trial balloon going off. They're going to raise money here. You're going to get taxed for driving by the mile rather than have a road tax, all this stuff. When the day comes, I think everyone will be so tired of it, it'll just be a bit of a relief to get out of the way.
I think that's absolutely right. It's probably what they're planning. And yeah, we'll see. But yeah, it feels like we're in the final stretches of that now. And hopefully we can get it done, get the bad news out of the way, and then all move on. And what about company-wise? We've had a little bit of news this week, a number of trading updates and various bits and pieces.
Yeah. Well, we had first half results from Trainline, which is a share that I follow quite closely. I think it's a great business with a great operating model, but it's been under a cloud due to the review of the railways that's ongoing. And I guess really Trainline is a play on the complexity of our train system, and particularly the ticketing system, which means that the initial driver of its success was due to the fact that it could help consumers navigate the complications of certainly long distance train travel. I think it's become a bit more widely accepted as just a way of buying train tickets. And I think that the derating that these shares have had in the period that the ongoing review of the railways basically offers an opportunity to buy a good quality business at a lower valuation than it normally would be on. These results indicate that they're tracking in line with expectations. In fact, they raised guidance for the full year well into double digits for profit growth. We also had Tim Martin of Wetherspoon giving us an update on how things are going in his pub industry. Only Tim Martin could start his update talking about the failings of the UK's nuclear energy policy.
Right.
But he also managed to have another go at the corporate governance regime and explain why none of the Mag 7 choose to list in the UK, because none of them conform with what he would regard as antiquated corporate governance protocols.
It's amazing how many things he can get into the things that matter for running a pub, isn't it?
Yeah. If only we'd build more nuclear power stations 10 years ago, he wouldn't have all these issues that he currently has in running his pubs. But
that could be true. But it's great that someone like him is out there saying it and saying it loud. So, yeah, that's good to hear.
But once you get through it all, the pubs have actually done better than expected in recent weeks. But the outlook is cautious given the upcoming budget and the potential impact of further inflationary pressures on wages. So he is again raising this whole thing about the increasing concerns over the automatic increases in national minimum wage. And I think he's not the only consumer company operator to have those concerns.
Yeah, no, it's a big thing. And what about the next week or so? What do you think we've got to come up on the macro side?
Well, Keir Starmer and I suspect Ed Miliband as well are in Brazil at the moment. So it's COP30 in the Amazon.
Of course.
And while they're away next week, the UK is going to have unemployment data for September, which is expected to be pretty well unchanged at around 4.8%. And we're going to get GDP data for September, which month on month is expected to be a little bit better than the previous month, but still pretty flat at around 0.2 of 1%.
Okay.
But I think the main focus of attention for investors is going to be the macro scene. And I think the main thing that people are going to start zeroing in on is the Supreme Court hearings over the legality of Trump's use of emergency powers for his tariffs.
Right.
And we've had the hearings on that. We probably won't be getting any decision whether the appeal will be upheld or not for several weeks. It could take as long as till June next year. So this is going to be a point of uncertainty, I think, for some time to come, but we're going to start talking about it more.
I'm sure we will. And yes, I'm sure there'll be lots of legal battles and machinations around that.
Yeah.
Brilliant. Thank you very much for your time again, Jeremy. Good to have you here. And We'll catch up this time next week.
Okay.
Talk to you then.
See you then.
Thanks.
Brought to you by Progressive Equity.